Hello, my name is Carolyn Lawrence, Director of Corporate Membership for the Association for Supply Chain Management, and I will be your host for today's webinar, COVID-19, How to Recover Faster and Help Create a Sustainable Competitive Advantage. I am joined today by a wonderful panel from PricewaterhouseCoopers, Mr. Mark Hermans, Mr. Brian Houck, Mr. Wynn Bailey, Mr. Michael Whitman, and Ms. Linda Meloro. Mark Hermans is a Managing Director in PwC's Industrial and A&D practice based out of Washington, D.C. Brian Houck is a partner in the Chicago office within PwC's Consumer Market Supply Chain practice. Wynn Bailey is a partner in the Chicago office with PwC's Health Industries practice. Michael Whitman is a partner in the Silicon Valley office within PwC's Technology, Media, and Telecommunications practice. Linda Meloro is a Managing Director in the Boston office within PwC's Pharmaceutical and Life Sciences practice. It is now my pleasure to present Linda Meloro.
Thank you, Carolyn. Hello, everyone, and welcome to our webinar today. What we want to do today is talk a bit about, as all of you are well aware and living through the crisis of COVID-19, what we want to do today is talk a bit about what happens next, where do we go next, and how can companies position and utilize their supply chains to recover faster and potentially create competitive advantage. So we're going to do that by first looking backwards and looking a bit at the 2008 financial crisis and what happened as we came out of that, what different companies did, and how they recovered, and see if there's some lessons learned that we can take going forward and apply to this situation, and then what are some things that are different. So we're going to spend a few minutes talking about that perspective to kick us off. But we want to use the bulk of the time today for a panel discussion. As you heard from the introductions, I'm joined today by my colleagues from across our different industry verticals. And we want to spend some time talking about what we're seeing that's similar and different in each of those different industry verticals. And sometimes, oftentimes, even within an industry vertical, different parts of that vertical are impacted differently. So we want to talk about that and go through a couple of the most common questions that we're hearing from industry executives, supply chain professionals, et cetera. And then we're going to spend a few minutes in closing and just provide some perspectives on how to think about all the different things that people can be executing, investing in as we come out of this crisis. So starting with the perspective, so how are we actually going to recover? Everybody has probably heard about the V curve, the U curve, the W curve, and even the last week or two, the prevailing theory seems to be that the recovery will actually look more like a swoosh with a protracted tail and recovery period. And the reality is no one really knows. And the even more important reality from a supply chain perspective is that the recovery is going to look differently across every geography. And so, what may be a W here, perhaps in South Korea looked more like the V or the U, et cetera. And as supply chain professionals, what this is going to mean is regardless of what the ultimate shape of the recovery is, supply chains are going to need to be more flexible and more agile and potentially customize their solutions by geography much more so than has been the case in our most recent past. And so, flexibility, agility is going to become one of the most important attributes going forward of supply chain. So for many of you on this call, working in the supply chain world, some of these questions on this page, along with a host of others, are probably things that you're thinking through dealing with every day. Things like, should we be dual sourcing? Do we have suppliers that are at risk of not making it through the crisis? Should we be thinking differently about where we produce products, about where we hold inventory, et cetera, right? So there's a whole myriad of questions that everyone is facing that just 6 months ago, right, we were not thinking about in the same way. So starting off, what can we learn from how people reacted to the last economic downturn and crisis? So I'm going to turn it over to my colleague Mark for a few minutes to talk about, as we went back and looked at the data from that crisis, what did we learn and how do we take those messages forward and apply them to this crisis?
Thank you, Linda. So one way to kind of think about all of these questions is to think about kind of the recovery as a life cycle, and that there is a life cycle from kind of the disruption through recovery to kind of coming out stronger and more resilience. And it is a way to kind of help get some of and prioritize actions. And I mean, clearly the majority of the emphasis right now is on kind of the immediate kind of disruption and mitigation. So on focusing on safety, getting back to work, cash, stabilization. But now is also the time to really think about kind of recovery and starting to think about kind of what needs to be done to kind of rebalance the business and where to invest, and also seeing it actually as an opportunity to gain market share through kind of investments like in areas like around kind of demand planning. So being able to better kind of anticipate where demand will pick up again, starting to invest in manufacturing flexibility to be able to respond more quickly, and then being able to kind of bounce back as soon as demand starts to pick up in certain geographies, and then being able to sustain that on the path to resiliency. So diversifying the product portfolio, diversifying the operational footprints, partnerships with suppliers, with logistics providers, with customers. I think what's different now is that given that the kind of the evolution of the recovery will be very kind of localized, many companies and supply chains will need to start kind of playing across these different stages simultaneously. So in some areas it's still more like hunker down mode. In other areas there's already recovery, and maybe in other areas it's a matter of shoring up the supply base, or relationships with strengthening the distribution network. But as Linda mentioned, I mean, there are learnings from the financial crisis. So let's take a look at those. So what you can see here is the graphic shows the revenue of a set of companies through the financial crisis. So you see the dip in 2009, and then you see kind of the difference between the leaders and the rest of the pack. From a revenue perspective. And first of all, you can see there's clearly that the leaders bounce back a lot faster, and also that they use it actually as a way to continue and accelerate the growth. Well, when we started looking into it, kind of what did those companies do differently? It was the level of continuity and investments during the crisis. So the leaders, they continued to spend. I mean, they were prudent with cost and cash, but they continued to invest in SG&A, so in sales and customer-facing capabilities. They continue to make capital improvement investments. So they spend more on CapEx. They spend sooner on CapEx, and then also we're very targeted with acquisitions. So there are definitely learnings around kind of investing early, focusing in the right areas that can then really kind of accelerate the recovery coming out of a crisis. And then if we double click on the supply chain, we're seeing a similar story there. That, so on this page are a number of scores, so supply chain metrics that we've collected over the years in collaboration with ASCM. And there are a few takeaways. I mean, first of all, companies with stronger and more responsive and more resilient supply chains, they were able to navigate the crisis a lot better. But also what you can see here is that those leaders also continue to perform at high levels and in some cases even improve their customer-facing performance compared with the average players. So on the left, you can see that order fulfillment lead time leaders improved, whereas for the average players, they actually deteriorated. Similar for on-time delivery, where the gap is even stronger, where you can see that the leaders continue to deliver very high service levels, whereas the average players experience a significant dip during that crisis. And that translates directly in market share loss. But what we're also seeing is that the leaders continue to invest in operational flexibility. So investing in distribution capabilities, manufacturing capabilities. So the big learning is that by continuing to invest in kind of the operational capabilities, very focused, and staying customer focused makes a big difference as you're navigating a crisis. So back to you, Linda.
Thanks, Mark. So now we want to open it up to our full panel and walk through a few of the questions that I mentioned that we're hearing, that we're talking with industry executives, supply chain professionals about, and get a bit of a perspective on how companies are reacting to this crisis, who's using those lessons, and our thoughts on what companies should be doing relative to these questions. So the first question and the most immediate and what we're hearing is, what should I do now to prepare for recovery? Or in some cases, you can make the argument that the recovery started, but what's the first things that I should be thinking about? Brian, from a consumer perspective, lots going on in the consumer world. Can you start us off with a perspective from the consumer markets?
Yeah, absolutely. So a lot of companies that have consumer-facing businesses, whether it be retail or their manufacturers of products sold to customers, are still in the cycle of trying to answer a lot of questions. The reality is that for the foreseeable future, there's going to be a lot more questions than answers, particularly when it comes to changing consumer behaviors, which ultimately results in demand, which we need to respond to in the supply chain. The interesting thing about this space has been we've been talking about disruption really consistently for the last 5 years, and then here comes COVID, which really kind of dwarfed everything that's been going on in this space prior to it. So when we think about how to come out of recovery, I think part of the philosophy that our supply chains need to take is that disruption will be going on for a long period of time. So we need to be able to shift from being invested in kind of single demand plans to adjusting the organization to figure out how do we react quickly, how do we incorporate new information and data sets into our decision making around where we expect demand to be, how do we kind of chase and capture short-term trends. For example, things that categories and products that we never would have thought would come back up again, like puzzles and bread makers, are flying off the shelf. So it really becomes about moving to a more scenario-based and agile planning approach to be able to make sure we can quickly respond and adjust the supply chain as needs change throughout the current cycle and the recovery.
Great, thanks. Thanks, Brian. So, Michael, what about on the technology side? There's, there's a lot of consumer-type products there as well as more large capital equipment. Are you seeing a similar type thing to Brian, or are there some unique things around the technology industry?
Yeah, no, within the technology industry, one of the unique things is with the high concentration of outsourced manufacturing and kind of a lot of build-to-order supply chains, a lot of our tech clients saw this early relative to what we saw in some of the other verticals and have kind of worked through that initial short-term, I need to secure supply, and they're starting to look now towards how do you manage, as Brian said, a long-term or an ongoing or some type of rolling disruption. And so what we see clients really focusing on from a supply perspective is trying to, one, understand who are the suppliers who will be there as this disruption continues, to make sure they have the financial strength to be able to be long-term suppliers, but also looking at what would the next disruption or a potential second wave of disruption do to the supply base. How do they start tires? And then as suppliers come back online, understanding what the lead time impacts of different safety measures that suppliers will have to put into play, because you won't be able to run factories the way you did previously. So that will definitely impact capacity and lead times, and making sure that's factored into your planning. And then similar to what Brian said, a big focus is understanding what your true demand is. All of the statistical models that our tech clients relied on for forecasting demand planning, those are out the window with something like this. And it's really making sure you get close to your markets and your customers to understand how the demand will be different, in the U.S. versus Europe, between two different U.S. states, two different European or Asian countries. How will that demand play out, and making sure you're positioning supply to be able to respond quickly as the demand picture changes.
Yeah, I think we can all agree planning the way everybody used to think about it is not going to be business as usual for quite some time. So Wynn, what about in the health industries? Right? Lots and lots of press about things happening in this industry. What
for sure. Healthcare companies, particularly pharmaceutical and medical products and medical device companies, are kind of having a moment in the sun here, or at least in the spotlight. And I agree with with the point that Brian made, that for life science companies, demand sensing is certainly going to be a big deal, and that includes demand that moves in both directions. So how long will demand spikes that they're seeing now for certain products and certain drugs, how long will that continue? And it's a particularly important question in the life sciences sector, because if companies are going to ramp up manufacturing capability, that's a fairly long-term prospect. It has regulatory implications, and they have to receive approvals and so forth. So a lot of them are thinking through making decisions now about whether or not to invest in additional capacity that might not come online for 6, 9, 12 months. And, will that spike in demand still be there, or is it a kind of a temporary sugar rush? And then on the other side, for demand that's cratered, when and where will patient demand for healthcare come back, which drives ultimately sales for, companies in this sector. And so they're thinking about, things that are, care that is life-saving and urgent in nature. That's, kind of continued during the crisis. But, most non-urgent elective kinds of procedures have been cut off. And so when will those come back? And so the ability to both understand when those will come back and to be able to gauge where, because it's not all going to come back in the same time frame, even within states in the U.S. or across countries. And then there are even more consumer-driven types of healthcare that are out there. Think of cosmetic procedures. When will those come back as well? In addition to the demand sensing, companies are planning for permanent changes, I think, that are going to be with us as the crisis recedes. So a good example in this industry is the rise of telemedicine, which has been forecasted for some time and has, emerged in a kind of a slow way. But, I think this crisis is going to, have long-term implications for how much care is delivered remotely, which if you're a supply chain professional in a life science company might have a lot of implications for how you manage last mile logistics. If you need to get something to a patient who's going to be seeing her doctor, on a Zoom call, there may be some supplies that patient needs at home in order to make that physician visit effective. And so how do you manage those logistics? And then I think, from an inbound supply chain perspective, certainly companies are thinking about ways to be less reliant on some of the extended global supply chains that, most of us have built, particularly in Asia-Pac.
Thanks, Wynn. So Wynn, continuing on that, that vein around suppliers and kind of longer term, beyond the first recovery, I'll leave the ball in your court for now. What about long-term strategic changes in supply chain? What do you think is going to happen here?
Yeah, from a healthcare perspective, and I think this is, applicable to all of the industries that are represented on this panel today. The chart that you're looking at now is a CFO survey that we update on a biweekly basis. And if we ask them, what changes are they considering in their supply chain, what pops is that the top 4 answers here all have to do with suppliers. Those are the highest top of mind issues, maybe more so than in-house, supply capability, manufacturing, and so forth. And so there's certainly a big focus that we expect across industries, but for sure in my industry and in health industries, a big focus on gaining more visibility into the supply base. Most companies are pretty good at understanding their immediate suppliers, but struggle a little bit as we get to tier 2 suppliers and beyond. So we're seeing much more focus on that and much more interest in developing capabilities and tools to allow that visibility. We're also seeing companies focus, not just on the direct materials that they, use for the production of their products and that show up on the bill of materials, but also the materials that are critical to supplying products that might not show up on the BOM. Things like, PPE that's used in the manufacturing process. And companies, have always paid a lot of attention to planning for direct materials, but not so much for these kind of non-BOM critical items. And so I think they're looking to inject more discipline into that process as well. And, maybe it's not a surprise that we're seeing lots of energy around identifying more local sources of supply. And that could be local to the markets they're serving, but could also be local to their manufacturing facilities and manufacturing infrastructure. Again, back to the point I made a few minutes ago about, trying to mitigate the reliance on extended global supply chains. And then another thing we're seeing is, a lot of focus on vertical integration as a tool for mitigating risk here. Some companies, I think, in life sciences who have done more of their, let's say, subassembly and component production in-house have maybe fared a bit better than companies that have relied on suppliers for that. And so we're seeing a bit more interest in that vertical integration topic as well. Certainly early days, and that could go in some unpredictable directions, but at least from a life sciences perspective, that's some of the stuff we're seeing in terms of how people might consider changes to their supply chain strategy.
Yeah, and I agree on the vertical integration thing, right? Even a year ago, 2 years ago, I don't think any of us would have been thinking that companies are reevaluating that, but here we are, right? And the PPE piece is also, I think, something that wasn't on anybody's radar screen, but we've had some clients in the device space that have had to significantly alter or were nearly shut down in manufacturing for lack of, PPE for their clean room employees. So definitely some surprising trends, but real. So, Michael, how about on the technology side? What are you hearing relative to sort of long-range changes in supply chain strategy that people are thinking about?
Yeah, and I think as you start to look at the key piece is really how do we start to build more resiliency into the supply chain, more flexibility into the supply chain, because right now when you're looking at the global outsourced supply chain, very much optimized on being able to take cost out, and I think now as companies are starting to re-examine that strategy, it's what does the cost profile need to look like going forward, because costs will still be important, but how do we get cost and have some more flexibility in the supply chain? And so in the short term, see clients looking at how can they start to build in some of that resiliency or flexibility by positioning materials closer to their end markets, just trying to create a break between a geographically centered manufacturing and supply base and a global demand, so moving inventory forward. But I think as this moves forward and companies continue to move through different forms of recovery, companies will start to look at what does the actual distribution and manufacturing strategy need to look like, and then what does the supplier strategy need to look like? How do we help have a globally diversified supply base as well? Because if you move manufacturing into a region but you're still highly dependent on a geographically concentrated supply base, you don't really have the flexibility that you think you do. So it's really taking that end-to-end holistic view in the long term of what should your supply chain look like.
Yeah, do you think some of the those concentrations of some of the raw material or component suppliers that will also become more dispersed? Is that what you're saying? That what you're thinking?
Yeah, I think as the large manufacturers, the large technology brands start to potentially move manufacturing back into regions to get closer to demand, that will naturally start to pull the supply base into those regions as well. Now that could be actual manufacturing of the raw components or the lower level components, or it could just be through some type of distribution strategy where that material is more available closer to the demand pattern.
Great. Brian, what about on the consumer side?
Yeah, absolutely. So through the consumer research we're doing, we're seeing a lot of emerging patterns that are going to be very impactful to your future strategy. When we look across categories outside of grocery, just kind of pointing towards apparel and healthcare and beauty, we've obviously seen significant drops in in-store shopping throughout the COVID period. But as we begin to ask consumers how they plan to shop coming out of COVID, we fully expect to see a significant shift in stickiness in buying product and fulfilling product outside the store. Early indicators are that we're going to see a minimum of 5% shift in acceleration of formerly purchased in store to e-com purchase. And we're seeing early indications of a 2 to 4% stickiness in buy online and pick up in store and curbside delivery. So what that means to the supply chain is, I think, is a couple key things. So with each volume shift from a store purchase to an online or pickup purchase, the responsibility of owning that customer relationship is increasingly burdened on the supply chain. So as operational supply chain professionals, we need to start the journey of really understanding the customer and our contribution to their shopping and buying experience at a much more detailed and granular level. And to be able to do that, we need to, number one, recognize that the shelf is no longer just the store. The shelf could be at the store, in the back room of a store, at a supplier we're drop shipping with, at an e-com facility, in a truck that's doing a pop-up shop in a neighborhood. And to be able to execute, to be able to position the product in the right place, be able to seamlessly execute that order for our customer, we need to be working in a much more cross-functional way. So improving and strengthening our relationships with our store operators, collaborating more in seeking better understanding with our merchants and our category teams to ensure that when that shopper makes that online decision that we are fulfilling it above and beyond their expectations and capturing what should be a growth opportunity coming out of the primary crisis.
Yeah, that's some fundamental change. That's going to be an interesting journey. All right. So thanks, Brian. Let's get into a little bit about the information, right, needed to really successfully execute something like what Brian was talking about. So let's talk a little bit about digital enablement. I think everybody on this call is very much more aware these days of the importance of connectivity and information sharing. But what about within the supply chain realm? And, how is this situation going to impact and potentially accelerate digital enablement, uptake on digital solutions? Michael, let's start on the technology side, the technology
Sure.
sector. What are you seeing?
Yeah, so I think one thing that this pandemic has really highlighted is the fractured and siloed nature of data in the supply chain. Whether you have a completely global outsourced supply chain like many tech clients, or even in cases where I have clients who have some level of vertical integration, there's a lot of very hard walls between those functions. And the data, it's hard to get data across those hard walls. So in normal times, a lot of the supply chain management time and effort is spent moving information across those functions, across your extended ecosystem of partners. And now when you see something like we have today, where you really need to have good transparency of what inventory do I have on hand at a factory, did I start all of my builds as planned, do I have the right number of employees in the factory to get the throughput, and so that I can make quick decisions. That information is just not there. So people have really reverted to a lot of manual war rooms to be able to try to piece together that transparency that's lacking in the supply chain. I think going forward, you're going to see more and more companies put together control towers. I've already had a few conversations in the past week or so with companies looking at having a control tower, but not like the control towers that have typically been talked about in the past, where it's very much focused on, say, logistics and getting status of orders. What's going to be needed to manage long-term in the supply chain is an end-to-end control tower that really gives you visibility into all the nodes of your supply chain and allows information to very quickly move back and forth between partners and between functions. And as you get that, you can really start to put together a new type of operating model. And what we've highlighted here is the way we are looking at this new type of control tower is it has different levels of capability where you can, one, sense that you have an issue at your factory, that, say, a shipment was from a supplier was late to arrive to the factory. Okay, that's great that you can sense that and understand it, but how do you know what's important? Because there's always going to be issues, and that's where we see technology really being able to help connect the different functions by being able to take information, which is a late shipment from a supplier at a factory, tie that to the order management system to see what orders are going to be impacted, being able to look into your forward demand plan to see how long of an outage will this be, kicking off replans and what if analysis, and then finally being able to act on in those analysis, and, for example, placing an expedited order from a supplier so that you can reroute in the supply and minimize the impact. So as I'm talking to clients, this is starting to really resonate of this end-to-end dynamic control tower that allows you to manage more proactively.
And do you see the, sort of heightened interest as well as trying to accelerate putting these things in place as a result of the current situation?
Yeah, I think there's part, is the current situation, but I think part of it also is just, the realization that even as we move beyond this, the siloed information hampers the supply chain's ability to really react as quickly as the market is demanding, and that these types of tools and automations can help the companies react more quickly to the market. And then you throw something like COVID on it, and it just shines a big spotlight on, hey, we have a fundamental issue here.
Great, thanks. So Brian, you were talking earlier about, just the change in consumer behavior. What do you see relative to, how that might then impact or play out relative to the, digital enablement, customer interface space?
Yeah, no, absolutely. So, we've watched really over the last 3 to 4 years a massive explosion in investment in terms of billions and billions of dollars in building out more flexible manufacturing lines, implementing more automation into distribution facilities. I think what COVID exposed is the amount of underinvestment in data. And I think going forward, I think we'd make the argument that data and visibility to that data is just as important as having the right physical assets. So we're expecting a huge push in being able to surface information across the supply chain and be able to use it to connect and orchestrate all the pieces together, as Michael was talking. So we believe that the magic formula is being able to use that data to connect the assets and be able to harmoniously use those together to kind of orchestrate what we make, where we make it, when we make it, and how we move it, and just as importantly, be able to communicate to customers and suppliers along the way when needs change or problems occur to be able to act resiliently. And it's very interesting. So we actually completed a study that was released last month about our operations digital champions. And as we looked at companies who had made major investments in surfacing that data and digitizing their supply chain, we see a huge parity between them and their ability to grow the business and to operate at a lower cost than the peers that we compared them to. So, and it's a very meaningful number in terms of cost structure of operating the supply chain. Those digital champions do it at around 7% more efficient from a cost structure than the other peers in the study. And then even more exciting as you think about trying to justify these investments to your C-suite and executives, is those contributions also were able to tie those to growth. So those digital champions are also able to capture market opportunities, increase their speed to market, ensure more in-stocks, and grow the business at 8% higher rate than the other peers in the study.
Wow, great stuff. Mark, what about industrial products? Quite a bit different industry, right? Is there anything unique different you're seeing? Are you seeing some of the same stuff relative to digital enablement?
I mean, the themes are very similar, like around kind of improving visibility, better use of analytics. But I also, what we're seeing is that there's just a true kind of acceleration of automation techniques. So not only in the factory to help, let's say, with spacing between operators in factories and creating a safer environment. We're also starting to see that companies are starting to kind of experiment a lot more with kind of things like robotics and drones for delivery. But also it has kind of really kind of accelerated the use of kind of remote interaction capabilities. So the analogy would be with telemedicine, but for example, for service technicians, like instead of sending a service tech out in the field to check a piece of equipment, you see now that companies are starting to rely a lot more on like remote diagnostics capabilities, and are able to see if a piece of equipment out there needs to be maintained, or a spare part needs to be replaced. So a lot of these capabilities already existed, but now we're really seeing a boost in adoption.
Great. Yeah, I mean, we're seeing, in addition to telemedicine, we're also seeing in the medical device space where, historically for certain procedures, the sales rep would actually be in the operating room, which, is a lot more dangerous now. And we're seeing a lot of that, at least temporarily. And we're, interested to see if it sticks, a lot of that being done remotely, right? We're seeing iPads in operating rooms and the technical experts being, conferenced in instead of physically being in the room. So, yeah, a lot of interesting stuff going on. So let's jump to another hot question and topic, which is, what does it mean, the current crisis mean for my global manufacturing footprint? A lot of, should I be in the U.S., et cetera. Do we really think that coming out of this crisis, people will change what their manufacturing footprint looks like? Mark, I know you've done a lot of work in this space. You want to start us off here?
Well, the first thing I would say, Linda, is that it's always important to reevaluate operations footprint, but I think COVID has exposed clearly kind of vulnerabilities in the supply chains, as some supply chains may have kind of over-rotated towards cost, and it's cost kind of being reliant on single kind of source suppliers or regions. But having said that, there are also kind of many other kind of forces in play, just macroeconomic, that already drove some of the change, or are driving changes in global manufacturing footprint. So, traditionally a lot of manufacturing was being done in China, but as what you can see here on the left, you can see that as labor rates in China have gone up, and other countries are becoming more attractive. So Malaysia, Vietnam, Mexico, and so there's already a shift was underway pre-COVID, but in combination with some of the trade and tariff kind of changes that are happening as well, it is forcing companies to really kind of rethink their footprints. The answer is always very dependent on the specifics of a product, kind of how much labor content is there in a product, how important is kind of proximity to the market, and also the criticality of an item to a company or an industry or even a country, like for healthcare. So the answer kind of varies, but overall we are seeing a lot of companies kind of rethinking their footprints and looking for particular to kind of diversify their supply base, but also looking into kind of diversifying their manufacturing footprint.
Okay, great. Michael, what about the technology industry? That's traditionally one that's heavily offshore. What do you foresee happening with manufacturing footprint?
It's similar to what Mark mentioned. I would expect that companies will start to diversify their footprint, and in many cases, companies had started that with the recent tariffs, had started to look at how do they diversify their manufacturing footprint, going from being basically a zero tariff industry to now having to deal with tariffs, really started to get people thinking about how to diversify. But it will come down to different parts of the technology value chain, how they'll react. So some where cost is, more commodity consumer electronics, that's going to be harder to bring back onshore or nearshore, just because the labor content will be hard to overlook the cost impact. On the other side of the spectrum, where you have highly automated manufacturing processes, say such as board level type manufacturing, semiconductors, things like that, there's more of an opportunity to bring that back on shore. There's actually been recent articles talking about the need to diversify some of those industries just for an assurance of supply for the tech industry and beyond. And then I think you'll see companies also looking near-shore opportunities, because not only does that help them diversify their manufacturing footprint, it helps them maintain some near-shore low-cost country cost benefits, but it also makes them just more responsive to their customer base on an ongoing basis, and it gives them some more flexibility. So I think you'll see definitely a look at this, but people are going to have to come up with a more nuanced answer than what the traditional answers have been.
Yeah, and I think for us in the health industry, in the pharma and med device space, we're also seeing the same on the commodity end relative to nearshoring. I think the other interesting thing that our industry is grappling with, trying to figure out is there's also this potential regulatory overlay in pharma and medical device, and is the government going to step in and mandate some level of production capability within the U.S., or just changes to the stockpile or what have you, right? So I think there's a bit of an extra unique factor that we're all grappling with in the pharma and medical device space as well on this topic that is going to be interesting in the years to come. So our last question here, last topic, has to do with resiliency, right? After each crisis, it seems we hear about resiliency, redundancy in the supply chain. What do we see happening in this situation, and is this the crisis that's really going to make it stick? So, Wynn, starting with you, I know you've spent quite a bit of time over the last few weeks on this topic of resiliency. What are your thoughts here?
Yeah, so I think the first thing to note is that everybody is focused on resiliency. But at least in the life sciences sector, it's not going to be a discretionary thing. You were kind of referring just a minute ago, Linda, to the regulatory overlay on this, and there certainly is one. In the CARES Act, the relief dollars got all the attention, but there is there's language and there are provisions that are built into the CARES Act that are going to lead to we expect new regulatory requirements for many healthcare companies, including, as you said, potentially a requirement that some products be produced, in the U.S., as well as a requirement that companies have resiliency plans in place that are subject to audit by regulators. You can imagine, that's the U.S. government. You can imagine other governments doing similar kinds of things. And so, we're seeing lots of interest in, how to enhance resiliency in the supply chain. Some of the topics that, have been, of great interest in the conversations that we've been having with companies would include, for example, the ability to build advanced sourcing intel and decision support capabilities and tools. The ability and approaches that you might take around supplier development. How can we take suppliers who might have capabilities that are relevant but don't supply what we need today, and how can we get them to the point where they can supply what we need today? And maybe a willingness as well to look, down the pecking order a little bit to some of the, level 2 players where you can be a bigger customer for those players and have more influence with them. And then we're seeing a lot of interest as well in building, sort of the next generation of supply chain modeling and simulation tools to help with decision making and priority setting around resiliency. So those are some of the topics that our clients have been raising with us. Of course, resilience isn't free, and some of the costs, like the little black boxes in the top left of the page you're looking at now, are a little bit easier to quantify. You'll know what it costs to build a new plant, for example, and other costs are maybe a little bit tougher to quantify or a little tougher to model, like what's the penalty you're going to pay for dual sourcing over a single sourcing, supply approach in any particular commodity category. And in healthcare, interestingly, we are seeing some companies and industries go on the offensive on this. So, a good example might be the generics industry that just a couple of weeks ago put out what they've called a blueprint for enhancing the security of the United States pharmaceutical supply chain. So they're looking for two things in there that I think are interesting. One is they're looking for direction from the government around which of their products are likely to be, of most importance in building a secure U.S. supply chain. So they're looking for guidance, from regulators and from governments on that. And then, they're being very aggressive in putting out a plan and an outline for the financial support that, that they'd like to see as an industry to support this development of, sort of a more nearshore approach. So, that financial support could include, guaranteed price or volume commitments from government buyers, like FEMA. It could include grants to subsidize investments that companies might have to make in order to, build manufacturing capacity in the U.S. Could include tax incentives, and could also include some proposals for regulatory efficiency improvements so that you can get quicker, sort of regulatory approval of new manufacturing capacity here.
Yeah, a lot of really unique drivers given the nature of the crisis for the life sciences arena. Wynn, thanks for that. So Brian, how about a completely different kind of industry, the consumer markets? What are your thoughts about where we're going from a resiliency standpoint?
Yeah, and it's really interesting because if you look back historically around supply chain resiliency, it becomes a very fleeting topic. As we've watched over years in various natural disasters, port strikes, labor shortages pop up, the concept of resiliency comes up, and there's a lot of talk about it, but in reality, it has been a lot of limited amount of action around it. I think if you surface the topics that Wynn brought up on a global economic basis, you overlay COVID, and you look forward to ongoing concerns about safety, which has to be a new factor that is considered in your resilience plan. We're increasingly seeing companies make decisions that will cost them dollars short term, but will create more resilient supply chains. The example that I would use is recently working with a company who had a high concentration of their distribution centers in high-risk zones, both earthquake zones, power outage zones, as well as some flood zones. And as they looked at building their next distribution center, they realized that their choices that they were coming up with through the modeling exercise were falling back in the same places that they had been in the past. But ultimately, as they started to fold in resiliency, they made a decision to build in a higher cost location to be able to give them flexibility should one of those events occur. So, I think it again is increasingly critical to weigh all the factors in this. And quite frankly, in the consumer markets, the customer is paying attention to resilience and safety too. So more and more, they're aware of how you're conducting business. They're aware of how you're treating your employees, and you don't want to do anything that is going to make them feel uncomfortable engaging with your brand or shopping your stores or buying your products.
Great, thanks. Thanks, Brian. So I'll just take a moment in closing us out here. We've talked about a whole host of different things that we're seeing clients do, we're seeing companies do, we're talking with folks and recommending that they do. So, how do we put those in perspective about, how do we think about them and where should, how should companies be making decisions on where to invest? And what we advise our clients is to think about the actions really in three different categories. Those things that we talk about as no regrets. So these are things, low or moderate investment required, potentially moderate returns, but they will be beneficial regardless of what the shape of the recovery curve looks like, and regardless of kind of going in position, right? So there's very little variance around those different V, U, or W shapes. And then and those no regrets are kind of the base requirements on what people are going to need to do to remain competitive. The next category is the strategic bets. So these are the bigger things, the higher investment, higher returns, but not everybody will be in a financial position to make these. And, these start to become some of the things that over the long term really will, as we look back, 10 years from now, will indicate, who the leaders and the laggards became, right? So these do require a bit of betting on a specific outcome and scenario. And then there's the third category, which are the option value type investments, right? These are riskier bets because you're basically kind of picking which direction you think the recovery curve will go, but they also generally are lower investment, moderate return type of things. So what do we mean by those? So we've talked about a number of them, those types of things today. No regrets things are things like safety measures for employees within your supply chain network, manufacturing, distribution, et cetera. Remote customer interaction capabilities. A thing we call supplier hospital. So, checking the financial health of your suppliers, shoring them up if needed, or finding alternative sources of supply. Those are the kind of things that we put in the no regrets bucket. The strategic bets, we're talking acquisitions, network footprint changes, potentially vertically integrating, things that require more investment, longer time to execute, and are more risky, but have the potential to really set companies apart. And then the option value things, this might be things like changing how you think about inventory, deployment, where is it, what stocking levels you hold in different locations, trying to dynamically adjust inventory around based on how the recovery pans out. Things like provisions for remote equipment diagnostics, and if you bet on the long recovery, are there things that then you can put in place to help manage through the supply chain in that long recovery versus if you bet on a quicker recovery, right? So there's no one answer for each company or each industry, but we do encourage people to think about, are all of your actions in the no regrets bucket, and what is that going to mean, 5 years down the line? Or are there, some strategic bets, option value investments that maybe carry a little more risk, but have the likelihood to set you apart for the long term? So we'll just close it out with a couple of additional takeaways for folks. And I won't go through this whole list, but I think we've talked about many of these things, and you'll see this really taking a hard look at things like your end-to-end supply chain transparency, use of digital, and ability to manage data through the supply chain. Thinking differently about resiliency, and is this going to be the time that people really do stick with it and invest for the long term, right? And is now actually the time to make investments in supply chain, even as the economic situation is challenging? Is your company situated to be able to do that? And can you then reap the benefits long term? So that's a couple, you can read through some of the other things on this page, but this is just some of the things that I would, recommend folks think about relative to their own supply chain. Okay, Carolyn, I'll hand it back to you.
Thank you, Linda. Wow, thank you, PwC team. So much great content. We appreciate it. We have received a lot of questions from our audience, and so I'd like to pose a couple of them to you before we wind up our time together today. First, what are the key differences in management response to this more unexpected crisis and the relatively cyclical 2008 recession?
Carolyn, this is Mark. I'll take this one. And I mean, it's an important question, and I mean, there are clearly differences between the financial crisis and the current situation. I mean, clearly there is a magnitude of difference where it's much more abrupt. We're seeing kind of instantaneous changes in behavior of customers and consumers. And yeah, so it's but at the same time there are learnings. I think there are learnings around kind of flexibility, staying customer focused, and those are all the things that do apply. I think the big difference, Carolyn, is that in the financial crisis, I think the mindset was more around getting back to normal. I think that the mindset for management kind of navigating through COVID-19 is that it's not getting back to normal. It's getting back to a completely world, and so it's a fundamental shift in kind of thinking about kind of how you approach your supply chain, how you approach your relationships with your customers, your footprint, and so on. And I think that is the big difference.
Great point, Mark. Appreciate that. And that leads into the next question that came in. How do you ensure then that the competitive advantages are indeed sustainable? You've given us a lot of really good ideas and thoughts, but how can companies ensure that those competitive advantages will be sustainable?
Yeah, Wynn here. I'll take a crack at that one, Carolyn. You know, I think what a lot of companies are beginning to realize is, you know, there's a lot of brand value that comes from supply reliability. And so I think there's, you know, a motivation to, you know, clearly a motivation to do the kinds of things that we're talking about today to drive some competitive advantage in supply chain. You know, one of the things companies can do is to look for opportunities for first mover advantage. So maybe that's you know, acquiring a distressed supplier or investing in supplier development, as we talked about earlier, so that you embed maybe preferred relationships with critical you know, companies that are in your supply chain. Another thing is you know, making sure that you build in the technology and the tools that are going to allow you to, you know, continue to drive on some of the fronts that we've talked about today. For example, you know, the scenario-based planning approaches that you know, Brian mentioned at the beginning of the call. You know, the third thing I'd say, and it kind of goes back to the page that Linda was talking about with no regrets investments and strategic moves and other moves that drive optionality, is to make sure that you've got a portfolio of things, that you're not relying on one single one single magic bullet, you know, to solve all your problems here, but to make sure that you're you know, pushing on multiple fronts and driving a portfolio of initiatives and activities.
Thank you, Wynn. Well, unfortunately, that's all the time we have for today. PwC team, Mark, Brian, Wynn, Michael, and Linda, I want to thank each of you again for taking the time to be here and for sharing such great insights. We hope you have all enjoyed today's presentation. PwC is a valued global alliance partner of ASCM and also provides valuable supply chain benchmarking for our ASCM corporate member companies. If your company is not an ASCM corporate member and you'd like to learn more about corporate membership and its benefits, please see our website at ascm.org. This concludes today's webinar. Thank you for participating. All contents and materials included in this ASCM online event are the property of ASCM. protected by the United States and the international copyright laws. All rights are reserved.